Swayam Prabha. Digital India. Educated India.
In this unit of security analysis and portfolio management, we are going to discuss about one of the important aspect in security analysis and portfolio management, that is valuation of equity shares. Although valuation of different financial instruments can be there, but in this case we are going to emphasize on valuation of equity shares of a particular company. So, in this we are going to discuss the basic approaches of valuation, different methods of valuation. So, coming to the basic approaches, there are two fundamental approaches, that is, one is a direct approach, another is indirect approach. As far as direct approach is concerned, we by applying a particular mechanism, we will find the value of the equity shares directly, whereas in indirect approach, what we do there, we value the company as a whole, and from there we derive the value of the equity shares. So, that is the fundamental difference in direct approach and indirect approach. Coming to the importance of the valuation of shares, any investor like to buy or sell a share depending on the intrinsic worth of the particular share as such. And so, the investor should like to know what is the value, intrinsic value, so that accordingly in the market he can take a buy or sell decision. So, if as per him the value of a particular share is rupees 50 and the market if is selling for rupees 55, in that case the investor will not like to buy that from the market, rather if the investor is holding that share, he will like to sell. So, in whatever the case may be, irrespective of the market price, the investor is likely to value the share on his or her own based on certain suitable measure that he feels that is right for the particular share. And the valuation of equity shares for that matter is quite subjective. Why compared to a instrument like valuation of bond and debenture, in which case we have got the periodic interest to come, then there is a repayment of principal is certain. Unlike that, in case of equity shares, what happens, whatever the investor is going to get from the shares is not certain. So, the dividends can be there, and another thing is the change in market price can be there, and change in market price is subject to market fluctuation. So, how much is going to be there by selling the share in future, nobody can determine in accurately. So, in that case what happens, different people depend on different method of valuation. So, there are a lot of subjectivities involved as far as valuation of equity share is concerned. One cannot find a single value that is appropriate or that is acceptable to different types of investors in the market, even if the company is one and same. So, further what we discuss in this module, the classic measures of valuation, and in that we have got asset based measures, then we have got valuation multiples, then we have got discounted cash flow measure. As far as asset based valuation measures are concerned, here the valuation is supposed to be driven by the value of the assets of the particular company. Asset is something which is held by the company to generate future revenue as well as future from that future cash flow. So, that is the, so the assets are good for the company, so the company is supposed to be valued well by the investor, that is asset based valuation. We will have different methods there. Then second category is valuation multiple. In valuation multiple, otherwise known as relative valuation. Here what happens, we will like to find the value of particular company share compared to the peer group. So, when you say peer group, that peer group should be in the same sector, almost of same size in terms of turnover or total assets of the company. Otherwise, there is no point in comparing those peer target company with the comparable company. So, comparable company should be essentially comparable in the way that they should be in same, at least from the same sector. So, if you are going to value a steel company, so we should have the valuation parameters of steel sector companies, and then we can find out the value of target company. And this relative valuation is quite popular in the case of those companies which are closely held by different promoters, it is not listed. So, there is no quote of market price available. So, instead of having the market price of this company, what we do, we have the market price of comparable companies from the market, and certain parameters are used, and then based on the valuation parameter there for the peer group or for comparable companies, the target company's value is found out. Typically, in case of mergers, acquisitions and sale of majority stake by the promoters, in those cases the relative valuation is quite popular. There are a couple of valuation multiple measures which we will discuss subsequently. Then the last third one in the category is discounted cash flow based measures. So, coming to the two measures, like the earlier two measures, which is the asset based valuation and the valuation multiple, they can depend upon certain accounting parameters, whereas accounting parameters can be manipulated. So, in that case there are certain experts who argue that instead of going for those measures which are based on accounting parameters so much, they can go for something like cash flow based measure, because investor is investing in terms of cash today and he will like to get back in terms of cash also. So, that is called the discounted cash flow based measures. So, what happens in this particular measure, the investors will be forecasting the cash flow for a particular investment horizon, and that cash flow which is going to happen in future, that will be discounted at a particular rate of return, and the value of the particular company, value of the equity for that matter can be found out. So, these are three classic measures of valuation. We also have two different methods again. These are actually, there are certain changes to the earlier measures, like for instance, there is a venture capital or private equity approach. In that case, what happens, private equity or venture capital is something who will like to invest privately with a company which has a lot of growth prospects, and this company is not supposed to be listed in the market also, and but has a lot of growth potential, and when the market price the value of the company appreciates a lot, and the venture capitalist or private equity can exit. So, when they do the valuation of the company, and venture capitalist and the private equity players will be investing in several companies, out of that so many may be successful, so many may not be successful. So, there is a lot of risk involved as far as venture capital and private equity players are involved. So, what they do in this case, what is the different yardstick they measure, they apply is that if they are using a cash flow based measure, so the discounting factor is going to be quite high compared to retail investors. In case of private equity players, it is going to be higher. So, they will discount at a very high rate, because they perceive that the risk is very high. That is going to be this little different approach as far as the private equity players and venture capitalists are concerned. Similarly, the valuation in case of mergers acquisition also can be little different from the valuation that a retail investor like to do for that matter. For instance, if by applying a proper valuation measure, appropriate valuation measure like the book value of assets, asset based measure, earnings based measure, relative valuation measure, or cash flow based measure. So, if the valuation per share comes to, let us say, rupees 15, and in that case, so the investor like to buy the share if the share is available for rupees 15 or less. Whereas, in case of mergers and acquisition, what happens, the large group of investor or a large or another bigger company will like to take over this particular target company. In that case, when the takeover takes place, they will also have certain subsequent, they are going to have a control over the company as such. In that case, whereas the retail investor, when they buy or sell the share of the company, they do not have any they are not going to have any controlling interest in the company. So, what happens if the 15 rupees was the value per share as per retail valuation. So, the in case of mergers acquisition, the investor who is going to acquire a controlling stake in this particular company may attach some control premium, let us say it is 20%. So, 15 rupees plus 20% 15 rupees, that comes to 3 rupees. So, from mergers or acquisition point of view, the acquiring company or acquiring investor will like to pay 15 plus 3 rupees control premium, that is 18 rupees instead of 15 rupees, that is determined by the general valuation measure which is applicable for retail investors. So, that is going to be the difference as far as valuation in case of mergers and acquisitions are concerned. Now, we move on to the different types of measures. In that, coming to the asset based valuation measure, which is where we this asset based valuation also measure is also known as book value of equity or book value of share for that matter. So, what happens in this case, we find the total value of the assets of the company as per the balance sheet whatever is there, how the financial statement called balance sheet, what it projects or what it depicts the different types of assets of the company, whatever that is, because as per accounting book, that is why it is called book value of assets. So, those book value of assets are total, and only those assets which has got some tangibility or something, some realized value as such. So, because then the assets can be there where certain assets like fictitious assets can be there which cannot have any realizable value. So, except those all the assets are clubbed and the total figure is found out. From there the total book value assets, the book value of outside liability, that is the liability for the, let us say the company has got some debentures, bonds or loans. So, their stake is going to be deducted from this, and whatever value comes out of that, that is the value of the equity shareholders, that is the total value book value of the equity, and this book value of equity is divided by number of shares of the number of equity shares of the company, that gives the book value per share of the company. So, this basic advantage of this particular method is that the investor or the valuer can rely on the financial statements which are supposed to have been audited by the auditors, and they are supposed to reflect a true and fair view of the company. So, that is something, if somebody can rely on the financial statements like balance sheet, then it is worth that one can consider the value per share as per book value of assets. But the major limitation in this particular approach is that company's value or company's revenue, company's cash flow, company's profit need not always be driven by the assets held by the company. There can be some other factors, intangible factors which are not captured in the balance sheet, that can drive the value of the company also. So, in that case, since those things are not captured in case of valuation of in case of balance sheet, in balance sheet. So, possibly this book value of assets, it could not be useful for such type of companies. For instance, if the customers buy the particular product of a particular company because of good brand, good image that has been created in the customer's mind, and they are not essentially captured in the assets of the company, but still the investor the customers are going to buy this particular product, and possibly they can also, they will be willing to pay premium over the other competitors of that particular product, and that realizes more revenue, more cash flow, and the factor that is driving more revenue and more cash flow is not reflected in the balance sheet asset side. In that case, this particular method like valuation, asset value based valuation method will not be suitable. So, one has to look for certain other methods which can take care of those particular factors. That is a major limitation. One more limitation is that the book value of assets is something like historical in nature. So, the accounting book value whatever is given and the assets are concerned, they may not be reflecting true market value as per today as such, as per the particular date when the valuation is taking place, because the inflation might have already taken place where the same assets can be acquired at a higher price by the company, and which is not captured in the historical value or the book value of assets. So, that is another limitation of this thing and the book value of assets approach. And third limitation is that the book value of assets is also subject to accounting adjustments, accounting guidelines, which are a lot of subjectivity is also involved. Different companies can follow different method of depreciation, and because of different method of depreciation, the net fixed asset value can be actually different. In that case, though the asset is one and same in two companies, but the value reflected in the balance sheet can be different, because the company has adopted different method depreciation, subject to of course approval of the relevant law or relevant accounting guideline. In that case, we cannot compare one company's value per share as per book value with another company. So, before we do that, we have to make some necessary adjustments, so that the value per share as per book value can be comparable. So, these are certain limitation of the book value of assets. Taking care of the limitation as that the book value is historical nature, it does not reflect the market value. We have another method that is called adjusted book value. In this case, what happens, the book value of assets are adjusted according to market value of assets then. So, when the valuation is being done, so instead of taking the balance sheet value as reflected in the balance sheet, the assets value, we can take the market value of those assets as on then when the valuation is taking place, and the market value of those assets can be more or less than the book value. So, accordingly these adjustments are done and then value per share is found out. So, in the we can take a simpler example here in the subsequent slide here. In this case, one can look at that this there is a company, there is a company A or B or X company, which has got the net fixed assets. When you say net fixed assets, it is net of accumulated depreciation. So, that book value is 200, whereas the same fixed assets can be sold in the market or can be acquired from the market for that matter, at the same condition it will be actually having 220 million rupees million as value. Similarly, the company has investments worth 100 million, and where the market value of these investments can be actually 110, and company has an inventory of 30 million, where the market value of the inventory could be 32. This book value is some assets which are actually reflect in the balance sheet, and market value is found out by the valuer by applying certain mechanism and making a survey and from in the market, and they put a value as per market value assets. Then come the receivables, though it is 50 million rupees is the book value, but possibly one can realize only 48 million from the debtors of the receivables, and cash and bank obviously there will not be any change as per market value book value is concerned. And there is a fictitious asset like miscellaneous expense to the extent not written off, that is 2 million. Obviously, it has no market value as such, and this company has an outsiders liability of 200 million, and that is also taken as market value of 200, because that is in the liability holder like to get 200 for whatever 200 they have, 200 million for whatever 200 million they have actually given. So, in that way the total value of the all the assets except this miscellaneous expense to the extent not written up, because there is a fictitious asset. So, this is not eligible for valuation of the equity assets. So, the valuation of eligible assets this 200 till 40 comes to 420, and then valuation of assets less liability is 200, that comes to 220. So, 420 minus 200 comes to 220, and the number of shares in million is 10, and then the value per share becomes now 220 divided by 10, that is rupees 22. This is the value per share as per the book value approach is concerned, the historical value is concerned, and since we have discussed that historical value of the assets can be something different than the market value. So, in this example already we have the market value figures for the different assets. In the market value term, the combination of these 5 assets comes to 450 million, and the 200 is the outside liability. When you take it out, so the value becomes now 250 million for the all the equity shareholders, and so per share value comes to 250 divided by 10, that is 25. So, as per historical value book value, that is rupees 22 is the value per share, whereas as per the adjusted book value approach that comes to rupees 25. So, if somebody is relying on the book value of equity formula for valuation of share, it is better that the investor or the valuer rely more on the market value of the assets and then find the value per share instead of the historical value, because market value is supposed to reflect the true value of the company as per the market condition for that matter. Then we have the next category of valuation methods, that is the valuation multiples or relative valuation, as we have discussed earlier. In this case, the valuation of a particular company is based on the value of the peer group of a particular company. So, when you say the peer group, we talk about the peer group means the company should be the comparable company should be from the same sector. So, if you are valuing company in pharmaceutical, we should have the comparable company from the pharmaceutical sector only, not that we find the companies from the steel sector and take the benchmark whatever the derived out of the steel sector companies and apply that to value the pharmaceutical company, because their two sectors are totally different, the risk involved in those two businesses are totally different, the type of value drivers are going to totally different. So, it is not right that one should go for a different sector for valuing one more other sector for that matter. So, what are the different methods or different approaches here? That is, we have in this case we have the ratio of a firm, or the instead of firm it can be also equity value to certain aspects of the company firm's economic activity, the major economic activity. It could be cash flow, it could be sales, it could be earnings before interest, tax, depreciation, amortization. It could be anything which is of important nature as per the financial parameters is concerned. So, we find a valuation multiple for different based on different factors, and whatever the factor that multiple we find, based on the factor that is applicable for the target company, we find a value of the particular company. So, what happens, the basic principle that we have here is that the multiples are used appropriately when comparing two assets that are similar in nature, that we are discussing. So, the for finding a pharmaceutical company, we should take a comparable company like pharmaceutical companies, they should be comparable nature. And also one more comparison can be there, is not that a new generation pharmaceutical company can be compared to the old generation pharmaceutical company. The company which was established for a long time may not be a necessary comparative company for a company which is actually set up just now. So, in that case, even if you are going to compare those two companies also, one has to make certain necessary adjustments to the financial parameters, then proceed with the valuation. Blindly comparing a 100-year-old company with a 1-year-old company is not justified as far as the relative valuation measures are concerned. Then multiples will be very easy to use when they are stable across similar assets. If we find that multiples are going to be changing from time to time for one company more than other company, so they are not stable, they are not behaving in a particular fashion, then it is better that we drop those things or drop those companies which are having erratic behavior in the multiple assets, and we can have certain companies where the multiples are actually stable across the time period, and then use that for that matter. But at the same time, multiples on its own can vary from time to time. So, when you say it is stable, means comparably in the same sector all the companies should show around same multiple. It should not be that one multiple is some case one company's case 3, in another company's case is 15, whereas on average it something 10 to 12 is the multiple for that matter. So, this 3 and 15 can be taken out, and 10 and 12 range that can be taken as the base for the multiple valuation multiple assets. Then going further about the relative valuation, different steps that we have here. The market multiples will be generally drawn from the stock price of the public companies or prices from the completed transactions. So, if we are going to value a particular target company, so we are going to have a set of comparable companies, and we are going to have the prices, stock prices of those companies which are actually listed in the market. So, that means comparable companies should necessarily be listed, because that only gives a market price, and then we go for a price multiple, and then we apply that multiple to value the particular target company. So, there is no point in having a set of comparable companies which are not listed in the market. But in case of mergers and acquisition, one can as well go for the transactions, that what type of such M&A or mergers acquisition have taken place in that particular sector, and in that case one can go for what are different types of M&A has taken place, and from there the value what has been paid by the company, and the basic parameter that is we are using, whether earnings or earnings before interest, tax, depreciation and amortization, that is called EBITDA for that matter, or book value could be the factor there. So, find the transaction based multiples instead of the market based multiple, because transaction based multiple depends upon the price paid by the acquirer to the target company. So, instead of taking the market price based multiple, one can take the transaction based multiple and apply that particular thing for valuing a target company in case of mergers and acquisitions. So, as we discussed earlier, in this case if you are going to find the price multiple as per the market price, and if you are going to value a company for mergers and acquisitions, so whatever price we find by applying the market multiple, trading multiple, then that case you have to add certain things like control premium, if you are going to value a target company for acquisition as such. Whereas, if you are using the transaction multiple of based on different mergers acquisition transaction that has taken place in that particular sector, there is supposed to be taken care, that control premium is supposed to have been taken care in those transaction multiple, that is the value of the target company when the target was valued by the acquirer. So, there is no need to have any control premium adjustment. So, that is the difference between the market trading based multiple and the transaction based multiple as far as mergers and acquisitions are concerned. So, there are two multiples we have, trading multiple and transaction multiple. So, what do we do, different steps that we have here is that we search for the target companies, then we select the comparable companies based on the target company's profile, and then what you do, there could be certain accounting adjustment that we will be discussing subsequent slides, and there could be certain accounting principles followed which are different in nature as per one company and another company is concerned. So, for instance, as far as the depreciation method is concerned, one company may following straight line method, another company may following return on value method. So, if that is the case, that is realized that these two different companies, comparable companies are having different accounting methods, then one has to adjust for those methods, different methods, and so that those companies, the peer group companies are really comparable with the target company. And once you have the adjustment to the financial figures, then we find the multiple, and from there you find the average multiple, and for the average multiple it is always better that one can use something like a median instead of a simple average, because median is supposed to take care of the extreme values. So, extreme outliers from the series of data can be taken out, so that whatever relevant range is there, and that is from there the average is taken. So, in that case the median is the best average as far as the valuation multiples are concerned. The moment one has the average multiple. So, let us say by having that a particular series of different multiples of different companies 1 to company n. So, the median multiple is if it is x, and the factor which was used for the multiple, and that is let us say y, then the value of the share of the company will be now the median multiple x multiplied with y, that is going to be the value of the share of the company. So, for instance, if the median multiple we are taking let us say price to earnings ratio as the multiple, the median multiple is 18, and the factor that is earnings per share in this case, if that becomes rupees 5 for the target company, that is for the target company, in that case the value per share will be the median multiple, that is 18, this is this one into the target company's earnings per share, that is rupees 5. So, rupees 90 becomes the value per share as far as this particular company is concerned. So, similarly, instead of price to earning ratio, one can take price to book value ratio, one can take to some other ratios also, but and accordingly if you take the price to book value ratio as the figure, then we will have a different multiple here, it could be x 1. Then we have some other valuation parameter, like in this case we will take instead of earnings per share we will take book value per share, and there will be let us say that is taken as y 1, the valuation of the company will be in that case will be x 1 into y 1, and one can note here that the valuation as per price earning multiple and the valuation of price to book value ratio multiple can be totally different. So, it is not necessary that if one uses different methods of valuation multiple, we are going to have same answer. So, it all depends whether we will use the price to earnings ratio multiple or we are going to use the price to book value per share multiple, that depends on the particular industry or company that you are talking about. It is not necessary that always we go for a particular multiple for each type of company, each sector of companies for that matter. So, having done that, we have to also look at other things here about the subject target company, which company we are target, that has to be looked at. So, we have to look at how this target company create value. Does this company and what drives its financial performance, who are its customers and suppliers, with whom does the compete, what risk does it face, what happens When you come to the create the valuation as such, as we have discussed in the asset based valuation measure. So, we discussed that if that measure will be appropriate for certain companies which are value is driven by actually book value of the assets held by the particular company. So, in that case if you are going for valuation multiple, then price to book value of assets multiple if you one can find out, then book value of asset per share or the value of the company to value of the assets per of the company, that multiple can be used there for the target company, because the value is driven by the assets held by the company. Whereas, if it is the value is not necessarily driven only by assets, but by several other things, in that case the asset price to book value method will not be suitable. So, in that case what will happen, one can go for something like earnings based valuation measure, or whatever that measure which is driving the value of the company, that should be taken as the base, and accordingly the target comparable company should be selected. Similarly, like value, what drives its financial performance, the financial performance like profit, sales, whatever depends upon what, that also has to be taken, and accordingly the comparable companies can be selected. Then we also have to look at who are the customers and suppliers as such. For instance, if we have got a particular sector company which depends upon outsiders for sourcing of raw material, in that case what happens, if you are comparing a company with all those who do not depend upon outsiders for sourcing of raw material, then they are not truly comparable, because the target company is subject to risk involved in sourcing of material from outside. It could be foreign exchange risk, it could be the political risk that is faced in the country from where the goods are being imported. So, in that case we have to look at that whether this supplier base is almost same from the at least for the domestic only. Similarly, there could be two different companies, and where one company may have these sales are more export related, the majority sales goes as export, whereas the target comparable companies we may end up that they are only having the domestic sales and their export sales are quite different. In that case, these two companies are actually facing different types of risk. One company which is having only the majority of the sales has exports, they are having a lot of foreign exchange risk and the business condition risk as per the particular country where the goods are actually exported. Whereas, domestic the company which has got most sales domestic, that is subject to only the Indian market risk for that matter. So, in that case they are not truly comparable. So, one has to again go on further search and find out which could be comparable companies having the same almost same type of customer profile or supplier profile for that matter. It is very difficult to find out the same type of company which have same customer profile, but one should at least make an effort to find out such. They should not be drastically different as far as the profile of the customers, profile of suppliers are concerned. So, this is a challenge for relative valuation measure to find out who could be the comparable companies to compare with this particular target company that we are going to value as such. And similarly, we have some other things that we talk about. Ultimately, we have got a inclusive list, that is the list of all types of company in that particular sector. Then based on this condition that we discussed in this, how does it create value, what drives the financial performance, who are the customers, based on that, then we have a certain exclusive list. Then you do a proper one more filtration could be that we have a exclusive list of 30 companies, but possibly for all 30 companies the financial parameters, financial values are not available. Then we go for a further filtration for where for those companies where the financial data are available for a particular period of time, then it becomes a small group of company, and that group of company becomes our the sample set, and from the financial data of those companies, then we find the valuation multiple and go further as the valuation of the share is concerned. So, it is possible that we can have multiple list also depending the target company. It is not necessary if you are let us say valuing two companies in the same sector, we need not have two different, we need not have one set to compare, we can as well go for two different sets. For instance, the company which has a turnover of 100 crore, possibly we should go for a set of companies which has got the financial parameter, same type of industry, at the same time their turnover should be around 100 crore, maybe 75 to 200, something like that, but not that you are having a target company's turnover 100 crore, then we are going for a comparable company like all the companies have got 1000 crore plus turnover, which is not a right comparison as such. So, similarly, for a 100 crore turnover company, we have a comparable list like that, and another, if you have a something like 300 crore turnover company, then we go for another list which are the sales of those comparable companies should be around 300 crore, something plus, something minus. So, for that matter we can go for multiple sets, and not necessary that we go for a single set of comparable company and compare it with any target company, even though the target companies are in same sector or same industry. Moving further, as we discussed, we may have certain accounting or valuation related adjustments. The fastest set of adjustment is known as the adjusting the market value. So, one has to be careful here whether you are going to find the value of the farm or value of the equity. When you talk about the value of the farm, then essentially when you apply that multiple, the multiple is based on value of the farm, and whatever value that you are going to derive, that multiple we apply to the target company's parameter, and then we end up finding the value of the farm for that matter, and from the value of the farm one can again go for value of the equity. But it is also quite possible that we from the beginning itself we have the parameters based on the value of equity, so that we can directly find the value of equity of the target company with the help of the average multiple that we have already found out. So, that is one. Similarly, coming to the next thing, that you have got the book value or market value of debt that we will talk about. So, when you are going to find out the market value of particular company or the comparable company, one can have a condition like this. Let us say the comparable company, we have a target company called T, and we have got a comparable company like C1, C2, C3 like that up to Cn. So, what you do here, and we end up finding the value of the company, and when you say value of the company or firm, we say the value of the entire assets and entire that is there in the company as such, and so in that case we can say the value of the total assets. Okay. When you go for the value of the equity of the company, what you do, whatever you have the value of total assets less value of liabilities, which are essentially outsiders liabilities, we do that. When you come to the extent of value of liabilities, there the question arises, should you take the book value or market value. The major problem in this book value market value of the debt is that so many companies the market value of debt may not be available. So, that is the case. So, one can take the book value of debt as the deduction for the value of assets, and then can go find out the value of the company of the comparable company, and then one can go for the multiple for that matter. So, what happens in this case, that market value of the debt is not available. Let us say the market value of debt is available, the debt are listed in the market price can be found out, then it is ideal that one can go for market value. So, otherwise book value of debt can be taken as a proxy for the market value. One cautionary note is that whatever value we take, let us say book value of debt or market value of debt, for this it should be consistent across the comparable companies. For one company we should not take market value, and another company we should not take, we should take book value for that matter. So, if you are taking book value from all the companies from in the target for the comparable company, it should be taken as book value. If it is market value, it should be taken as market value. So, mostly the market value is not available. So, we end up taking a valuation of debt as the book value of the debt as such. Then we may have some special cases of like convertible instruments like convertible bond and convertible then debentures, then we may or convertible preference share, then we can also have an warrants. Warrants are such things which are instruments which can be exercised, and by paying certain amount a shares can be issued by the particular company, okay, at a particular value. So, the warrant holder has a right to buy the share of a particular company or a particular predetermined price may be related to the market price or the discount to that or whatever that for that matter. So, when you are valuing a company at a particular point of time, if you have a warrant holders, we have to find the value of warrants like a value of something like option that is also considered, and those value of warrants should be taken out from the value of the firm that you have already found out, because that is the value of the firm or value of the company as per the present stakeholders are concerned. Warrant holders are the potential stakeholders of the company. So, the potential stakeholders may have some value as per the warrants are concerned. So, that is taken out from this value. So, what happens if we find the value of a particular firm is rupees 100 crore and the value of the warrants outstanding which are not yet exercised by the investors is rupees 5 crore, then we say rupees 95 crore is the value of company as far as our further comparison, valuation, multiple calculations are concerned. So, this 5 crore is essentially taken out of this 100 crore. That means, we are saying the potential stakeholders of the company who are the warrant holders now, they have a claim on the asset of the company to the extent of rupees 5 crore. So, from out of 100 crore 5 crore is taken out. So, 95 crore is the value of the company as far as the all the present stakeholders are concerned. This is the way one can take out. Similarly, there can be example of non-operating assets. Non-operating assets means the company is holding the asset, but is not generating any revenue or the cash flows. In that case, the non-operating assets should not be considered the value of the company as such. So, from all the comparable companies, we should take out the value of the non-operating assets, and the value of the company should be based on the operating asset than non-operating assets. So, these adjustments should be done to the value of the company as such. So, in the comparable company approach. Then some other adjustment that we have, adjusting the operating metric. One can note here the market value is in the numerator and the operating metric comes in the denominator. So, ultimately valuation parameter will be the market value in the numerator and the operating metric in the denominator. So, in that case one has to adjust for something like inventory accounting. Certain companies can be there which may follow inventory valuation like FIFO method or LIFO method for that matter. So, if the companies are following LIFO method, then accordingly some adjustments is done, so that the companies are becoming comparable. Similarly, as we discussed earlier, depreciation method could be different. So, one has to do those accounting adjustments for inventory accounting. There could be some extraordinary items. Let us say we are having a valuation multiple like value of the company to earnings before interest and tax. As we know, this earnings before interest and tax can be affected by certain extraordinary item that is typical to the particular company in that particular year. Let us say earnings before an interest and tax a particular company is rupees 10 crore and there is an extraordinary item which was there before EBIT which was taken, which is an income in nature, it was rupees 2 crore. In that case, the EBIT should be adjusted back to rupees 10 crore minus rupees 2 crore for that particular target company or for the comparable company. So, the adjustment that you do the operating metrics, it is not necessary that we do only for the comparable companies, we do it also for the target company. So, that the valuation parameters, valuation metrics are common as far as the different companies are concerned. So, there is no discrepancy as per different methods followed, different accounting practices followed like that. Similarly, there could be some non-recurring items. So, we should remove those items. Then there may be certain companies which may claim certain compensation to the owners as a salary. Actually, in that case the owner's salary, if it is already deducted from the income and the then profit has been found out, in that case the owner's salary has to be added. For instance, in this case even after adjusting for 2 crore of extraordinary item, we got a normal earnings before interest tax of 8 crore. Let us assume in this case the target company, let us say this is a target company's earnings before interest and tax, and the target company has got owners compensation paid by them as rupees 1 crore during this particular year. Actually, in that case what will the EBIT for our comparison will be now rupees 8 crore plus rupee 1 crore. So, So, that is rupees 9 crore becomes the comparable EBIT as per the target company is concerned. So, if such things are there also in the comparable company, that also has to be adjusted. So, that is one. Similarly, there could be certain intangibles like research and development expenditure, goodwill amortization. So, all those intangibles could be there or the adjustments have been done, and those adjustments have led to reduction in the profit parameter like EBIT, EBITDA. So, in that case one has to go for the adjustments. That means, in that case one can go for multiple like before the adjustments have actually taken place. So, in that case instead of EBIT one can end up have a multiple based on earnings before interest, tax, depreciation and amortization. So, the amortization, that A in this EBITDA term takes care of the amortization of intangible assets. So, that has to be taken out, so that it is not affecting the figure. So, before amortization what if the profit is there, that could be the base as the comparable multiple. So, these are the certain adjustments which the valuer should do while before going for the finding valuation multiple. And coming to the different types of multiple that we have is, we can divide the market capitalization of the particular company divided by the profit after tax of the company. When you say market capitalization, we mean market, that is also known as MCAP popularly, which is nothing but market price per share into the number of equity shares. So, the market price of particular company share is rupees 80 and the number of share is 10 crore in number. So, the value of the market capitalization comes to 800 crore. So, this is the value which is an aggregate value. If we are taking the aggregate value of the company's equity, then the relative valuation what happens, we have something like a value here, we have got the valuation parameters of the metric for that matter. So, if the value is taken as aggregate value like this 800 crore, then the metric should also be on the basis of aggregate, it should not be a per share value. So, if we are going for a valuation multiple like price to earnings ratio, in that case what you do, the price is the market price per share and earnings E is earnings per share. This is market price per share is earnings per share. So, if that is the case, if you are applying this, we should not do the mistake of dividing the value by earnings per share, because earnings per share is in per share, whereas value is a aggregate basis. In that case, instead of taking earnings per share, we will take the market capitalization as the value, and instead of earnings per share, we take the profit after tax of the particular company, and whatever you do, whether MCAP by profit after tax or price to earnings ratio, the value as per the both methods are concerned, that is going to be one and same, it will not be different. So, one has to be careful, if you are taking the in the numerator the aggregate value, then denominator also should be an aggregate value, that has to be done. So, in that case, if you look at this particular slide, we have the market capitalization divided by net income, that is profit after tax, market capitalization divided by dividend, then market capitalization could be divided by net cash flow, market capitalization could be divided by earnings before tax, or market capitalization can be divided by the book value of the equity of the company. So, in this case we have some 5 multiples we have here. So, that means the investor will end up finding out 5 different multiples, and so one will be the market capitalization to profit after tax, one is going to be market capitalization to dividend paid, like that 5 different multiples can be there, and 5 different multiples can end up finding out the 5 different value of the particular company. So, that is one. So, what happens, the further step that we do here, we will find the market capitalization by net income or something like that. We have, let us say, comparable company C1, C2, C3, C4, C5. So, like that we have the market capitalization by net income or profit after tax. We have certain figures, let us say 5, 7, 8, 6 and let us say 9. So, what we do here, these are the valuation multiples of comparable companies, and we go for an average we can go for average as a median, or the range is not substantial between lower value higher value, we can also go for a we can go for a simple average. So, in simple average the combination of this is comes to 35, and average there is 5 companies are there, that becomes now 7 is the average M cap to profit after tax multiple. Now, what you do here, we should have the target company, let us say target company's profit after tax is rupees 10 crore. So, the value or the market cap should be as per this parameter should be rupees 10 crore into the parameter, that is 7. So, the value of the company's equity should be rupees 70 crore. So, this is the way one can apply the formula and find out this. So, what we did, we found the multiple here for different companies, we found the average of that, and this average has been multiplied by the parameter in this case is our profit after tax of this particular company. So, if this company is listed in the market, and then the market capitalization will be approximating towards rupees 70 crore based, that is which is based on the comparable companies. So, like that different other parameters like market capitalization dividend, market capitalization to sales, market capitalization to net cash flow, all those things can be used and values can be found out. The fundamental method remains one and same. Similarly, next category that we have is, instead of dividing the market capitalization by the parameter like profit after tax or dividend for that matter, what you do here, we divide the stock price by the parameter per share. So, when you took net income in the first category, we are now taking net income per share, that is price earnings per share. When you took total dividends in this case you take dividend per share, and instead of taking market capitalization of the entire company, we take only market price per share, and then accordingly the division is done. So, what happens, the stock price divided by the earnings per share or the market capitalization divided by net income will end up having the same value only. So, we can go for aggregate basis in the numerator denominator, we can also go for an individual per share basis also. So, let us look at an example here. These are certain companies in the pharmaceutical sector like Cipla Limited, Divi's Lab, these are part of CNX Nifty index in India, and on a particular date in March 2009, 31st March 2009, the price earning ratio of these companies are for Cipla is 21.99, for Sun Pharmaceuticals it is 18.21, and there are certain companies are also negative multiple also there. So, this negative multiple is actually reflected because the earnings per share of this particular company could be negative, and accordingly has been found out. So, similarly, we have the price earning ratio, and what has been done here, instead of taking this average, the median of this particular multiple are 16.43. And one more thing here, whenever we have a negative multiple like this, it is always better that we remove these things from the this particular company's list, it is always advisable, and in this case this particular thing automatically been taken out because we have used median, and median takes care of the extreme values. Obviously, among these set of 10 companies, this minus 3.44 is one of the extremes, it must have been taken care by the median as such. So, 16.43 is the median price earning multiple. So, if we have a target company of earnings per share is rupees 5 on a particular for a particular date on 31st March 2009, and in that case we multiply 5 with 16.43. So, value as per the P multiple average comes to 82.15. Similarly, the price to book value ratio of these companies also have been found out, and for example, Divi's Lab is a company which has got 4.89 is price to book value per share company per share. Similarly, we have a company like Dr. Reddy's Lab which is 1.57, and the median price to book value per share is 3.67, and the book value per share of this particular target company is 25, assuming like that. So, value as per P by B multiply is now 91.75. So, it is not necessary that value as per P multiple should be same as value as per price to book value multiple. So, like that different multiples can be found out for the comparable companies, and then average can be found out, and that can be used to multiply the target company's financial parameter, and the value of the particular company can be found out. Going further, we can also have something like an enterprise value. When you say enterprise value, it is not value of only equity shares, it is value of all the investors that the company has, and this enterprise value multiple will essentially end up find the value of the entire company. Once you have the value of the entire company, then you take out the value of the liabilities, that becomes the value of equity, and the value of equity can divide the number of shares, that gives us the value per share of the particular company. For example, if we have got a enterprise value of companies and then EBIT of different comparable companies, that multiple is let us say average enterprise value to EBIT is 3, and the EBIT of a particular company, target company, is rupees 20 crore. So, the enterprise value becomes now 20 into average EBIT, that is 3, that is rupees 60 crore. So, this is the enterprise value. From that we less the value of liabilities, with that let us say it is rupees 20 crore. So, the value of equity is now rupees 40 crore. So, this is the value of the equity, and then you divide this rupees 40 crore with number of equity shares, that gives the value per share. So, this is the way to find out the you have a enterprise value multiple, then we from the enterprise value multiple we get the enterprise value as such, and the enterprise value multiple can be with the help of EBIT, EBITDA, EBITDA, then we have sales can be there, gross profit can be there, total assets can be there, net fixed assets can be there, different multiples can be there, then whatever is found out, then the value of the target company in terms of enterprise value also can be found out. So, we can look at it here. So, value is in this case value market value of equity plus market value of debt divided by earnings before interest, tax, depreciation and amortization. Then there is another formula which talks about there is a no cash version. From the numerator we take out the cash, and then when we take the cash, then if there is any income from this cash or the security, that is also removed from the denominator, and then the appropriate multiple is found out, and this multiple can be used for different companies. There are certain other multiples also which are industry specific multiples. Instead of depending on the financial parameter, one can depend upon certain industry specific multiple, like a steel company multiple could be the market value of invested capital to the ton of steel. So, because steel company's value is driven by more of how much the ton of steel capacity this particular company has. So, accordingly, if you have target company which a ton of steel is also given, that can be used as the operating parameter, and the multiple can be used to find the value. Similarly, for a cable TV operator, we can have number of subscribers, the value driver there. So, accordingly we can have a value per subscriber. Similarly, for retail company we have a market value to the square feet, because more for retail company to do good business, they should have as much square feet area. So, that is the one of the value driver of particular company. So, accordingly bottlers have a different cases, how many cases of bottles are being sold. So, like that technology based companies will have patents based or scientist based. So, these are the different parameters which are financial parameters, which are non financial parameters which can be used also to find the value of the company. So, in this module we have discussed about the different methods of valuation. In this we particularly focused on the asset based valuation measures and the relative valuation measures, and the subsequent session we are going to talk about the valuation based on the cash flow, based on the different multiple valuation methods as per cash flows are concerned. Thank you.